Wednesday, August 17th, 2022, here with your market commentary, talking about which direction rates are going, what's going on with rates the last week, where we think they'll go the next couple of weeks. Joined today with Jason Turner from Navigator Mortgage Brokers. Did I get that right?
Yes, sir. You got it.
Awesome. And what state are you in? Where do you originate? What state are you based in?
I'm based out of Maryland. I do Washington, D.C. presently as well, but mostly Maryland.
Okay, so just wanted to get an idea where in the country you are. So everybody, Jason is a vetted VA VVA 5. So what is VVA 5? What is that level? Last week we had a VVA 4. So what did you do to get VVA 5?
VVA 5. So it means I've been into vetted VA for a couple years now, and I've progressed. I've been a leader through the squad ranks, and I've progressed a lot, and really basically established myself as a leader within the community. And so once they realize that, and we take on a little bit more responsibility as far as educating clients and the community in general. So it's a little bit different role now for me, but I love it.
Awesome. Fantastic. Well, thank you for joining us today. We're going to talk about rates and pricing, and I'll ask you some questions on your opinion on stuff, and you tell us what you think, and anything that you want to add, feel free to add. Also, I tend to kind of once you get me going, I like the Energizer Bunny. So if you want to talk, just kind of like jump in, give me a signal and come on in on the conversation. Sound good?
Cool. Sounds good.
Awesome. So, all right, everybody, let's start off with showing up the slides first here, and we'll do a quick, let me put it on the pretty page for you. Hold on. We'll make it look pretty and show everybody. So, of course, today is August 17th. Let's do a quick recap. What happened last week with mortgage rates and pricing, and what I thought on Monday when I wrote this, what I thought would happen this week, and we'll talk about what's actually happening, and then kind of a forecast of which direction rates are going and why. So first, a quick recap of last week. Rates did get slightly higher. Jason, did you see a noticeable movement in VA rates, or was it mainly just rates might have been a little higher, or their rebate pricing, their closing costs might have been a little more expensive?
A little bit higher, yeah, a little bit higher from Friday to Monday. Noticeably for me, that's what I saw.
Yeah. So not too much. Average mortgage rates improved slightly last week after data came in showing both consumer and wholesale inflation data. Data didn't improve, rather. It got I said slightly worse, didn't I? I said they're slightly better. Average mortgage rates improved slightly last week after data came in showing both consumer and wholesale inflation data may have peaked. So that's right. Quick thing. We talked last week about inflation, and a couple of times, Jason, I like to use an analogy that mortgage rates move with, it's almost like a horse race. We got fear of inflation and fear of recession. And as you see the headlines, when we see a lot of fear of inflation, then rates get worse. And when you see fear of recession take the lead, rates tend to get better. So recessions push down rates, inflation brings up rates. So whichever direction markets are kind of leaning and pricing in is what we're seeing mortgage rates go. So last week we got some data. We got consumer and wholesale inflation data, and it actually came in pretty good. It wasn't good by any means, but it was better than the month before. So right. The idea here, a lot of the economists and pundits out there think that inflation may be peaking. And if inflation is peaking, now that fear of recession is going to grow as the Fed continues to step in. And we've talked in some of these, as we do this each week, and any of our consistent viewers, you guys know that we've talked about the Fed is raising policy rates, which doesn't directly raise mortgage rates, but mortgage rates do go up because of it. And as the Fed raises these rates, that has, driven down the ideas that drives down inflation, but it is going to increase that risk of recession. So last week when we saw the inflation stuff kind of take a back seat, then more of a risk of recession. Everybody thinks that the Fed may to slow down interest rate increases, which the next one is September 21st, everybody. So that's your next Fed meeting. So putting this back up on the screen here, and we'll go through this one more time. So the forecast for this week, I put out there on Monday. I said that rates may worsen a little bit this week. While rates may not likely get significantly higher, we could see them get slightly worse if markets shift to anticipating a larger Fed rate hike at the September meeting. And like we just said, it's September 21st is the next Fed meeting. So right now, markets are divided on whether the Fed will raise rates by either 0.5% or 0.75%, and mortgage rates will worsen on speculation of the larger hike. And I'm going to come back and talk about that with Jason in a minute. The other things that were affecting rates this week, we had some economic data, a lot of housing data. You guys will see a lot of headlines on the housing data, and I want to get Jason's opinion on that too. I think some of the headlines are a little misleading. They make it sound like the housing market is doing a lot worse than it really is, and
Yeah.
that can affect you guys when you're out there looking for homes. We'll talk about why it's still a great time, and why you don't want to wait too long, because the media makes it sound worse than it is. And then the other thing that was happening is we saw some what we call retail sales this morning, and that's basically consumer spending, and that came in basically unchanged from last month. And what we were looking for, if that spending had come in lower, that shows the economy is slowing down, and that helps mortgage rates improve. If it comes in higher, that shows that the economy is still heating up. It's inflationary. So kind of came in flat, didn't have much of a role today. We also, the things that are affecting rates this week is going to happen in about 2 hours, and that's the Fed meeting minutes. The meeting that occurred in July, we're going to get the minutes from that meeting, and investors, traders, markets, they're going to be looking for signs. What comes next? What is the Fed going to want to do on that September meeting and through the end of the year, as far as raising that Fed funds rate, that policy rate that the Fed uses to try to, slow down the economy? And then the last thing is, I'm going to show you all some technical indicators. We're going to look at some fancy candlesticks and the charts, and I want to just show you guys a little bit about what we look for as mortgage professionals and what we can kind of use to get an idea of which direction things are headed and why. So, with that was kind of the beginning component. Let's start off with talking a little bit about, let's kind of, before we get to the rate specific, let's talk about the housing market stuff. So Jason, you were nodding your head when I said that the media tends to be a little bit dramatic about some of the housing. Do you want to talk more about that?
Yeah, for sure. Because a lot of people look at the current market and they're like, "Oh, it's another crash. It's another crash," but it's really not. And I think it's a lot of scare tactics, but from what I see, at least in the media. So I'm not a big fan of that. I mean, inventory is still relatively low compared to what we normally see, and I think the market is still very strong, even though we're seeing a cooling off period. Regarding sales prices, we're seeing price reductions and such, but I think that's just normal because things got so hot. I mean, it was just not sustainable. So, I mean, it's only natural to see a little bit of a cooling off period right now. So, I mean, at least that's what I see. I'm seeing a little bit of buyer pushback and some sellers kind of adjusting their mindsets as far as, going for outrageous sales prices. But, in general, I mean, I still think it's a very healthy market.
I agree with you wholeheartedly. And here's how the media can maybe scare you if you're out there looking to buy. And it says, the U.S. housing cools further with fewer starts, meaning there's less new homes that are starting to be built, more canceled deals, construction starts to decline, the weakest pace since early 2021, more deals fall through. Home Depot sees fewer transactions. Well, last time I checked, Home Depot doesn't sell houses, but and this was a great chart to kind of just put it in a visual for everybody. So housing starts, new home construction was at 1.44 million units. And if you look, yeah, that's less than 2021, because through this time frame, we've seen some really increased numbers. But if you go back a little bit before 2021 to a more normalized market, it's still more homes started than 2016, anytime in 2017, 2018, all the way to the end of 2019, crossing into 2020. So it makes it sound like there's this huge dip or this huge thing, but the reality is it's less than what we've seen in this really, really crazy last couple of years where it's been upside down world. But on a more conventional window, there's still a tremendous amount of homes. There's still new homes being started. I have a theory too, Jason. I'm curious if you'd agree or disagree with this. So I think that, especially like national builders, if demand has cooled because rates have gone up, so there are less buyers out there, and when demand goes down, they can either lower prices to increase demand, or they can cut back a little bit on supply, maintain those profits, and keep that hunger. What do you think? There's any validity to that idea that maybe they're just not in such a hurry to start new homes right now because of the price of lumber, the difficulty getting labor, and they'd rather keep the profit margins up?
That's really tough to say. I mean, I know they all want to be profitable, but I don't know, man. They were in the driver's seat for so long. Well, feels like so long anyway, that it's really tough for me to say. I mean, I think they're probably watching the market and seeing what it does a little bit as well, and maybe holding back on some inventory purchases. I mean, for lumber and such, just to
Yeah.
see kind of what it does and maybe hedge their bets a little bit. Honestly, that's probably what I would do if I was in their shoes. I mean, instead of taking on excess risk, that's probably what's going on.
Yeah, and a lot of headlines too. They talk about home prices. There's been reductions in asking prices, and the reduction in we've really got to be clear for everybody watching. It's reductions in asking prices, not reductions in sale prices. Have you seen in your market in that Maryland area, that Washington D.C. area? Have you seen home prices going down, or maybe just slowing down as far as the appreciation?
Going down, actually going down. And I've seen a lot of price reductions. In fact, I mean, the last, I mean, call it 2 months, maybe 3 months, I've gotten more price reduction emails than, I saw last year. So I've seen a lot of prices going down from sellers wanting to move their homes. I mean,
But
unless sorry, go ahead.
no, no, I was gonna say. Well, my question to you on that though is it that one home sold at 800,000 and then they asked 900, but it's falling back to 8? Or are you seeing that somebody bought at 8 and now that next home is selling at 750? Are you seeing prices themselves really drop, or asking prices come down?
Asking prices.
Yeah,
Asking prices are coming down for sure.
Okay. Because
Yeah.
that was kind of the where I was going with it, is that home prices are still very stable. It's just that we've seen this appreciation of 20% year over year. So you've seen where your neighbor's house sells for 800,000 and the next one's 825, and the next one they say, okay, well, let's ask 850. And that's kind of how real estate works. Is agents will encourage sellers to continue to ask, higher amounts. Their job for a seller is to help them to sell for the maximum that they can get. And amongst other factors. And so they'll ask higher. But what they're finding is now that demand has pulled back a little bit, those asking prices have dropped. But we haven't seen where prices of homes themselves are going down yet, where people are losing equity for buying a home. That's what I was asking.
Yeah, I mean, honestly, God, I mean, that's tough to say. Like, I would say, since sales prices are going down, I mean, they are losing some equity. They are. I mean, because houses are sitting and they're not getting what they want. So, that I'm seeing a lot of price reductions, outside of high demand areas, the good schools and good communities and such like that. But anybody with, something that's not so great, they're not getting what they want, honestly.
Yeah. And that's what we've seen too. So awesome. Well, let me jump over. I'm going to go ahead. Let's talk a little bit about rates again. I'm going to pull up that screen and I want to kind of go over with everybody. Let's talk about where rates are going and what kind of movement we've seen and why. So basically, this is that chart that I told you guys I was going to share with you. And I've talked before about where mortgage rates come from. And basically you have two variables that are, if we simplify the process, two variables that come into play. The basis for mortgage rates starts on the bond market with how these mortgage-backed securities are selling and how they perform. That's your day-to-day and even intraday movement. Now, by the way, when I say an intraday movement, I wanted to leave this up for everybody to see. So this is a real-time chart of how mortgage-backed securities are selling. And when they sell for more money, then mortgage rates actually get a little bit better. And when they sell for less money, they get a little bit worse. And when you see an alert like this, that's where when you're pricing out and you're trying to compare lenders, you want to make sure that you're comparing lenders not even the same day, not even the same week, but almost the same time. Because we can actually have changes to interest rates that occur during the day. And that's called a reprice. And that'll happen because the market is moving. And down here at this little chart, I'm going to make this bigger for you, this line chart down at the bottom so we can all see this. I'm going to change it to 2 days. So this chart here, if we look, this is kind of very flat. It's a level line, if you will. It doesn't go up or down too much. And that means mortgage rates on the day are generally pretty stable. Then we have a big drop that you see here, and that's from one day to the next. And the reason that you wake up on Wednesday and the rate you were quoted on Tuesday is not offered anymore is because of a movement like this. We see this this mortgage bonds lose value and mortgage rates will get a little bit higher. And either your rate itself will change or the rebate pricing, the credit you were getting towards closing costs or the amount that you would pay to get a particular rate is going to change. And then that'll actually keep going up and down through the day. Now, through the day, you could see that we've started to lose some ground here. And as we lose this ground, what happens is lenders are in a position where they actually have to change mortgage rates in the middle of the day. And we call that a reprice. So that's why if you're going to shop around and Christopher Griffith and I've talked about that before, you definitely want to shop around, make sure that you're shopping apples to apples at the same time frame. And this is why there's a real time. In fact, these are lenders starting to actually make adjustments to their rates. So, you can actually see that difference. And that's why on a day like today, it may be very frustrating as a consumer. And you're like, hey, how come what you quoted me yesterday isn't the same rate as today? And that has to do with bonds and the way that bonds are selling here. And that's why when you hear me talk about the markets, we talk about stock markets and bond markets. In the bond market specifically, we're tracking on how this coupon, this mortgage-backed security is actually trading. And when this number is negative, and the bigger the negative, the worse that things get, the worse rates get. Now, we watch this pattern. And we could see that a couple of days ago, rates might have been a little bit better. And then today they start to get worse. And we say, okay, well, why, Hammer, why are they getting worse? And I talked before about the technicals and what this green line is right here. This is what's called a moving average, and it's the 100-day moving average. So all of these little different candlestick lines that you see, this is the average as taken over 100 days. And what traders are looking at when they're looking at, they're always trying to be ahead of everybody else and make money in the market. And they'll trade based on these technical indications. Which way are things going and why? So this is a negative indication that we're seeing today. We've seen that we have not been able to break above this. So what I'm going to do is I'm going to change this to what's called a line chart. So it's rather than the candlesticks, we'll change it to a line so that you guys can just see it a little bit clearer. And when you look at this line, you'll see that we've pushed up to it's now purple. We've pushed up to this, but then we fell below it. And we kind of got close to it here and then fell below it. And we pushed up to it again, but we couldn't make it. We only broke above it for just a day or 2 days ago, or actually about a week ago. So what happens is when we look at this, we can forecast that what's like more likely. Is it more likely that we're going to see rates get slightly worse or get slightly better? Well, we would need to see this line move up to get better, and we would need to see it move down to get worse. And if this is kind of a cap or what we call a resistance level, it's pushing rates to continue to get just a little bit worse. And that's what we're looking at recently. And that's why at the beginning of the week, and I said, hey, one of the things that we have is this technical indicator that based on the performance of mortgage bonds, we may not be seeing rates get better this week. So when I give you a forecast and I say rates may worsen, one of the things that I'm looking at is this pattern here. And I say, okay, how likely is it that we'll see something happen here? And then when we're looking for something to improve, we're looking for usually what we call a fundamental, something that's outside of the market that's going to help it improve. So today we would get those Fed meeting minutes. And if it sounds like the Fed is likely to take a more accommodative stance and they're less likely to raise rates aggressively, we would see things improve. And what we've talked about before is you're going to see mortgage rates go up when the Fed raises rates. It just doesn't happen at the same time. Mortgage rates move on speculation of what the Fed is going to do, whereas when the Fed makes that move, we usually see a counterintuitive reaction. So if the Fed raises rates, mortgage rates may actually get a little bit better that day. But right now, there's these two graphs that you see here. The one on the left is the idea that the probability of a half a point rate increase, and the one on the right is the probability of a 3/4 point rate increase. And again, we're looking at this all the way in September, more than 5 weeks from now. But as the market thinks, hey, we're more likely to see a larger rate increase by the Fed, that gets priced in now. We see a negative reaction here on these bonds, and then your mortgage rates get slightly worse. So the news that we're looking for, if we were to get those Fed meeting minutes today, and those meeting minutes kind of showed that based on the last meeting, the Fed may be a little less aggressive, maybe they're more likely to take a 0.5% rate hike, we could see things improve a little bit. But if we start to see that idea that maybe the Fed needs to be more aggressive, and this is again to curb inflation, that's why the Fed is making these moves, is they need to curb inflation because it's getting out of control, then that's going to see mortgage rates get just slightly worse now. So, Jason, does that make sense to you? Did I explain it in a way that everybody should at least be able to kind of grab it?
Yeah, absolutely. That made total sense. I mean, I get it. I'm hoping that they fall for sure, though.
Yeah, we definitely want to see rates fall. Where do you think rates will be, over the next few weeks if you're counseling your consumers, or what do you generally tell consumers when they ask you about when should they lock in, or what's a good time to do that?
I mean, I'm a lock immediately type of guy. Honestly, like if somebody gets under contract, I'm like, let's lock because there's certainty. I'm not a float to a certain point kind of guy or anything like
Mhm.
that. If I'm quoting a refinance, it's like, hey, this is what the market is. I don't know what it's gonna do. It
Yeah.
could do this or it could not. I don't know. Like there's so many variables, but that's generally how I handle it.
Okay. And then, so, what about for somebody that's under new construction and they're not going to be closing until later in the year or 2023 and they can't lock in a rate yet? Do you think that they have anything to worry about, that rates are going to get much higher, or do you think that rates will stay where they're at or maybe get lower as the risk of recession increases?
The latter. So I think they'll either stay where they're at or get lower over time. I do believe that. At least I'm optimistic for that. But
Yeah.
that's my hope for 2023. I mean, I think the likelihood of a further recession is kind of high. So looking into 2023, I would say that rates are likely going to be lower. We'll just have to see though.
Yeah, absolutely. And I agree with that too. So for everybody that's watching today, if this has helped you out, please remember, go ahead and make some comments. Let us know that this has helped you. If you have any questions, put them down. We'll be sure to answer them. Jason can answer them, and I'll be watching them as well. And then if you're watching this on the replay, do us a favor and just put hashtag replay. Let us know you watched and that this was helpful to you. But as far as that forecast, so this week we are seeing rates get a little bit worse. Not anything that you have to panic over. If you're closing sometime over the next couple of weeks, it's probably prudent to consider locking in before things get worse, because they may get worse for a few days in a row, and you don't have enough time to recover and see rates improve after that before you have to close. So if sometimes that one in the hand, two in the bush kind of thing, where it's better off to just be locked in right now. And again, talk to your mortgage professional if you are under contract and you're working with somebody. But that's kind of where things are at, recently. As we get into that September area, though, if you've got a loan that's closing later in September, as we get closer to that meeting, we're going to see this chart that I've showed you with the Fed futures and this idea of how much is the Fed going to raise rates. We see this move back and forth. And as the sentiment of the markets believe that we'll see a lower rate hike, it's a good opportunity to get slightly improved rates. As the expectation comes of maybe a higher rate hike, it puts things a little bit at the higher side. And again, these are still better rates than we saw in June, not as good as we saw in January, but right there within that range. We've seen some consistency. They're not moving too dramatically. And, if you're closing later in September, depending on your risk tolerance, you may see some opportunities to get slightly better rates than where we're at today, but maybe not a lot of them. So it's not a bad time to consider locking if you want to just, protect yourself. And one thing we always like to talk about is when somebody does lock in and they close, what happens if rates drop in 6 months, Jason? What should somebody that's gotten a VA mortgage, what do they have available to them that's one of the coolest things ever?
Oh, the interest rate reduction loan, the VA Earl. Yeah.
Yeah.
So obviously did a lot of those last year and the year before that. So, I mean, that's definitely an opportunity available for any veteran, who's eligible. So,
and their parameters, if somebody did want to refinance, if they did close, how long do they have to wait? How many payments do they have to make, and how long do they have to wait?
6 payments in 210 days. So 210 days from the closing date. And then of course, 6 payments is the minimum. So after that, they're eligible.
Yep. So, that's always something to remember, is if you are closing now, this is not necessarily the rate you're married to forever. And if rates do get much better, you'll have an opportunity to save some money. And there's a very good likelihood that we will see better rates in 6 or 7 or 8 months from now. And you'll want to stay in touch with whoever helps you to purchase your home, because they can help you to refinance as well, and to take advantage of that EARL program, the rapid rate reduction refinance. I think it's 4 R's in there, 3 R's in there. The EARL is rapid rate reduction loan. So, or rapid rate, is it rapid rate refinance? What does the R stand for?
It's interest rate reduction loan. So interest
rate reduction refinance. I think there's 3 or but we'll have to look though. So anyway, it's funny. Now I want to Google it. But all right, everybody. Well, anyway, it doesn't matter what you call it. It's going to save you money. So make sure that you definitely stay in touch. And it's a good time for that. If you guys have any questions about what's going on with rates and pricing and, that kind of thing, you can jump on these Facebook posts or YouTube or wherever you're at and ask, and we'll monitor that. Jason, anything you'd like to add before we wrap it up for today?
No, I enjoyed being here today. Thanks for having me.
David said it is the interest rate reduction refinance loan. That's I thought I had the 3 R's in there. Yeah. So thank you, David. Appreciate it. Yeah, we're numbers people. We don't worry about the R's in there. Right. So great info as always. Thank you. We appreciate you. Other people here live appreciate you as well. So if anyone has any questions, make sure that you put them down and we'll answer them then. Otherwise, we'll see you next week. Take care, everybody.